All right, welcome back, everyone. As many of you know, today you can't really turn on the news without seeing the impact of climate change. And it has massive impacts across financial services. So today, facilitating our expert panel for a climate discussion is the head of financial institutions and mortgage broker conduct and media superstar, Annette Leung. Annette, please introduce your panel.
Sure. Thank you, Judy. I'm very excited and delighted to moderate this panel. As a consumer protection agency, FISRA vision is financial safety, fairness, and choice for consumers. And we know that climate is impacting everyone as consumers as well as business. So I'm excited that we have two experts with us today to talk about how businesses can adapt their business model to continue to provide services for consumers. And I'd like to introduce our two experts. Dr. Blair Feldmate is the head of the Intech Center on Climate Adaptation at the University of Waterloo. And Paul Kovacs is the founder and executive director of the Institute for Catastrophic Loss Reduction at Western University. Their full bios is on our conference website, so I want to jump right into our discussion. So maybe before we start, I would like to ask each of you to set the stage for us about what is physical climate risk, what are some of the things that we're currently facing. Maybe I'll start with you, Blair.
Sure. Thank you very much, and I'm pleased to be here this morning to talk about climate change. And I thought I'd start out with something that, quite frankly, I can tell you right now for the first couple of minutes is going to be a little bit depressing and it's not going to put you in a good mood. But I just want to really profile the formidability of the challenge we're facing with climate change, extreme weather risk, emphasizing the point that it is irreversible, period. Climate change is here to stay. We're not going backwards on climate change. We can slow down the rate of climate change by lowering the discharge of greenhouse gas emissions into the atmosphere, but we're not going backwards. And this is not my cavalier opinion. This is an opinion expressed by a variety of authoritative agencies, both at the national level and internationally. And if you'll allow me, I'm just going to read one or two sentences from various agencies talking about the irreversibility of climate change. For example, in 2019, the federal government of Canada, through Environment and Climate Change Canada, they wrote a report called Canada's Changing Climate Report. And this was authored by more or less about a dozen climate scientists from Environment and Climate Change Canada. So they had the proper authority to pay attention to what they're saying in this report. And in that report, they state, and I'm quoting, "Canada's climate has warmed and will warm further in the future, driven by human influence," which is the burning of fossil fuels that puts CO2 in the atmosphere and traps energy that would otherwise escape into space. It stays in the system and causes warming. Driven by human influence, this warming is effectively irreversible. And this is the first time that I'm aware of that the federal government of Canada recognized the irreversibility of climate change. And then in 2022, from the Intergovernmental Panel on Climate Change, they wrote a report called Climate Change 2022, Impacts, Adaptation, and Vulnerability. And this is a group of several hundred climate scientists that's all they do, 7 days a week, is study climate science. And they wrote, and I quote, "It is indisputable that human activities, the burning of fossil fuels, are causing climate change, making extreme climate events, including heat waves, heavy rainfall, and droughts, more frequent and severe." And then just a few months back, the United Nations Environmental Program released a report called Broken Report, and they said there's no credible pathway to 1.5 degrees Celsius. So point number one is we're not going backwards on climate change. It's here to stay. Extreme weather will get more extreme as a function of time. Sometimes you'll hear in the media, they talk about the new normal of climate change. There is no new normal. There's just evolving risk. We can slow down the rate of change, but it's going to get more challenging over time. And I'll leave it at that and maybe turn to Paul's thoughts.
Sure, Paul.
Thank you for including climate change in the conversation today. From the research that I have been doing and the research that I've been following, our climate has changed. There's significant further change coming. And this is going to profoundly change the business of all of the financial institutions being monitored by FSRA. As a consumer of financial services living in Ontario, I'm counting on regulators, supervisors, to assure me that the financial institutions are properly managing these risks. The failure of policymakers to deal with climate change has resulted in two fundamental risks for financial institutions, one being transitional risk and the other being physical risk. So it's the supervision of how financial institutions across all the sectors are handling transition risk and handling physical risk that I'm concerned about. It's my opinion that on the physical risk area, you've got property insurance companies that are about 10 years ahead of all the other financial companies. They've been working on this file for more than a decade and doing some very prominent things and really trying to manage these risks. But on the physical risk side, outside of the property insurance industry, there's very little going on, and there's a lot that needs to be done. Some headlines in Quebec, as Desjardins made some announcements about their lending for people living in floodplains, some common sense stuff that I think should have happened years ago, so it's great to see some changes starting to happen outside of the insurance industry. But they're way behind the leadership that's been in the insurance industry. On the transition risk side, as Mark touched on earlier today, knowing how financial institutions are investing, knowing how financial institutions are lending, who they lend to, it's a lot more complicated with the change that's happening in the climate about the right investments to make. And OSFI's leadership to look for disclosure about how financial institutions are thinking about these risks and thinking about this transition that's taking place, for me is very exciting. It's great to see the change that is starting to come. Anyway, so for me, setting the context, the climate is changing. It's going to have a profound impact on the financial sector. Having leadership from FSRA and OSFI to oversee how financial institutions are thinking about and managing this is incredibly important. And I think within the sector, the regulatory sector, terms like transition risk and physical risk are going to become really commonplace, like prudential risk and market conduct risk has been for many years. So understanding what those terms mean and how to properly act upon that, I think will be really important going forward.
That's great. So that's actually a great segue into our first question, which is, what do you think each of our regulated sector can do to better prepare for extreme weather that is to come? And I know that you've both mentioned that on the P&C side, property and casualty side, there has been a lot of thinking about it. What about our other regulated sectors? Blair, do you have any thoughts on those?
Yeah, I think and there's good news here, by the way. We actually know what to do before turning to the sectors. We actually know what to do if we're talking particularly about property and casualty insurance and life and health insurance, because people's houses and basement flooding, we now know quantitatively that this adds psychosocial mental health stress to people. It affects lost time from work when their houses are flooded. It's not just a P&C issue, now it's also a life and health issue. But for example, for flooding and wildfire, which are the two most costly physical climate risks realized in the country, and flooding being the number one peril, and then out of that residential basement flooding being the most costly expression of climate change in the country. That's the bad news. The good news is that over about maybe the last 10 years or so, working with organizations like the Standards Council of Canada, the National Research Council, Canadian Standards Association, I think ICLR, and I like to think the Intact Centre and others, what we've developed over the last 10 years for the country is very good, practical, meaningful, cost-effective guidance as actions can be taken or implemented to mitigate flood risk at the level of the home and at the level of the community, And the same for wildfire. We know what to do to mitigate wildfire risk for homes, businesses, and communities in forested and grassland regions to make it such that when a fire comes through, it doesn't burn down every home or burn down the community. Now, for property and casualty insurers, for example, one of the rather deeply involved in, one of the areas that they're pushing very aggressively, and the Insurance Bureau of Canada and others, is giving direction to homeowners as to actions they can take around their property, generally speaking, over a long weekend, without special expertise, for very little money, in the hundreds, maybe the low thousands of dollars, that on a scale of 0 to 100, 100 being the worst for basement flooding, you can take a home from an 80 down to a 20, just like that, by providing the appropriate information to people to act upon to protect their homes. The reason they're not protecting their home for most homeowners is not that they won't do it, it's because they don't know what to do. But when you actually give them the information, simple diagrammatic, infographic style information, we find that 70% of people will take 2 actions to protect their homes from basement flooding within a 6-month period that they otherwise wouldn't have done. Now, let's see with the credit unions, a role that they can play, and I'll give you one tangible example. So I'm going to mention Meridian, and this is positive news for Meridian, just in case Meridian's here and getting nervous. On Meridian's website now, they list infographics. They present infographics on their website to their customers that they can, or members I think they call them, that give them guidance on how to protect their home from basement flooding. The property and casualty insurers are doing exactly the same thing, rolling this stuff out in simple language to help people help themselves. And now also we have the life and health insurers on board doing the same thing. So the formidability of the challenge, it almost can't be overstated. But the good news is we know what to do to counter the negative effects.
That's great. So it's helping consumers help themselves so that businesses can continue to offer services. And just so everyone knows that a lot of these resources are actually included in the conference website, so take a look at that. Paul, are there anything else that we're missing that you think the regulated sector should be thinking about as we encounter more and more extreme weather events?
We know the change that's coming to the climate in the next 25 years or so. There will be more large storms, the kind of storms that can cause damage. About 90% of the damage in Ontario over the last 50 years or so has been 4 different kinds of risks. As Blair has touched on, basement flooding and wildfires, also severe wind and hail. And for each of those 4 climate-related risks, we know how to protect our buildings and our infrastructure. All of the protective actions are known. Critical thing for the financial services sector is to encourage people to start to bring those features into effect. My home is 130 years old. Most of the modern ideas weren't put into the home when it was built. They had to be added, and so I've added it to my home. But the data shows for most of the homes in Ontario, the most fundamental protective measures are not yet in place. And that's why the losses have been getting up to the billions of dollars a year. That's why the financial services industry is struggling, because you have our housing sector spending billions of dollars just to fix the damage that's been occurring because of flooding and wildfire and wind. And until we start making the investments to protect ourselves, we're going to have these problems grow with climate change. But as Blair touched on, the exciting news is that we do know what to do. We've got proven solutions, they're affordable. Our research shows you spend $1 and you save 5 to 10. So the economic case is very, very strong. We just need to get more people to act upon the known science.
That's great. So we talked about insurance, we talked about credit unions. What about pension plans that have an obligation towards their investors or their beneficiaries? Any thoughts on that front?
Yes. So the pension plans in the country to date, in talking about climate change, have almost been looking exclusively at transition risk. What does it mean to portfolios for companies they invest in as they have to move towards net zero and lowering their carbon footprint and realizing the costs associated with a carbon price? So there's lots of good thinking around that, largely driven by by SFAC, the Sustainable Financial. I forgot what SFAC stands for now because I'm trying to think about it. Doesn't matter. The point is, there's been a lot of work on transition risk factoring into pension funds, but what's now also happening is we're looking at physical climate risk and the incorporation of physical climate risk into investment decision making, such that and across different industry sectors, mining, forestry, petroleum, utilities, hospitality, telecommunications, financial services, we are making fairly good strides forward, saying under each one of these industry sectors, what are the key perils, flooding, wildfire, ice storms, snowstorms, whatever it might be, that are most problematic for the continuity of business operations on all these different industry sectors. And then below each one of these impacts, perils, what are the top 1 or 2 impacts that if you are a portfolio manager, you should be zeroing in on to see if the company you're about to invest in or hold or divest, the degree to which they're actually embracing actions to respond to the risk associated with that peril hitting this impact. So right now, on an industry-specific basis, we're incorporating physical climate risk into institutional investment decision-making, because otherwise, and by the way, every industry sector is impacted by physical climate risk. There is no sector that's immune. I had a graduate student sit down a little while ago, and I said, I just want you to go through the headlines of the major newspapers for the last 5 to 8 years and write down any headline pertaining to physical climate risk, a flood, a wildfire, an ice storm, whatever it might be, and linked to a particular industry sector. And I thought, in this case, he would come back with a few headlines. Well, we could wallpaper, the walls of this building with all the different headlines pertaining to how everything from fisheries to ice wine making to you name it, a sector is being hit by physical climate risk. So for portfolio managers in institutional investing, they should be really looking seriously at preparing themselves to ask the right questions pertaining to physical climate risk for companies they invest in, and the tools are largely being developed to do that.
That's great. So it's helping pension fund managers to look at how their invested companies are risk managing, and then from there.
And by the way, it's Sustainable Finance Action Council. That's SFAC. Yeah.
That's great. I'm going to change gear a little bit. I'm just keep being very mindful of the time here. Board of directors, anything that you think a board of directors can do so that they're better equipped to give oversight over their management when it comes to physical climate risk, what needs to change, what advice would you have for them? Maybe I'll start with Paul.
I'm really excited by the leadership that OSFI is showing to promote disclosure by companies about how companies in the financial sector that are supervised federally are thinking about transition risk and physical risk. And some of the disclosure involves describing the management plans to deal with these risks. As management is documenting this is bringing the board into the conversation. This is a new conversation, I think, for most financial institutions as they're engaging the board. I do believe that there's a lot of board members realizing that they don't feel ready for this conversation. They don't have the background, they don't have the training. You have a lot of experts that Blair and I work with in the climate community, not great communicators. So climate can be made into a very complicated conversation. So who are the right people to have on the board? It's not always a climate specialist who can give that guidance about what the right practices are for industry. So it's a real art to find out who should be on the board and what kind of training the board members should have. But having the overwhelming evidence that climate change is one of the most profound impacts that's happening for all of the financial sector, having boards think about who are the right people to have on the board and what's the right training so that they can support management, make decisions about investments, decisions about loans, decisions about where to insure, is a really big need. And the push going on within the prudential side through OSFI has been really exciting.
That's great. Blair, anything to add?
Yeah, I would say, because we're asked to be in front of a lot of boards talking about this stuff. And I find for boards, by and large, very competent people sitting on boards. And I don't know if it's by luck or design or a combination of both, but I find they tend to have people on the board who know about cybersecurity or artificial intelligence or where long-term interest rates are going to head at a global or national level, whatever it might be. But by and large, there's a real paucity of expertise at the board level in reference to climate change. Mm-hmm. And I think they need to take a more concerted effort to find people who are fluent in that discussion and bring their expertise to the table. It's sort of like having a pharmaceutical company that has nobody on the board of directors who's a pharmacist or a medical doctor. It would stand out as a void in knowledge. But for boards to give appropriate oversight to management on this file, I think they need someone who's taken more than a weekend course on climate change.
It's great. So education and seeking expert advice. That's what it is. So let's switch a little bit. Let's talk about the role of financial regulators. What are some immediate and midterm actions that a financial regulator like FSRA should consider to make sure that we have a healthy market and consumers are continued to be offering choices?
Mark shared with us in the conversation earlier today just how broad a mandate FSRA has and how specific some of the questions are as you move from one financial sector to another, to another, to another, to another. Climate change is cutting across all of that. And there's not many issues like climate change that are affecting all aspects of what's happening here. So that's distinct and special here. And so for me, that's quite intriguing that bringing climate change into this conversation, despite some nuances about how it affects individual sectors different, it is definitely cutting across all the sectors. It's having a very profound impact on all of the sectors. So there is an opportunity for FSRA to get involved. It will certainly include a lot of the information type role that FSRA has regularly been playing, how all of the different groups that are being supervised can be informed with common information about some things that are happening. And that can happen quickly. The fact that, as Blair and I are sharing, on the physical damage side, the solutions are known. Let's get on with them. I mean, some of these things can be done today. They don't need time to develop. They can be put out very quickly. There are other elements that definitely spread over the multi-year focus that you're asking about, what the supervisors need to do over a longer period of time. OSFI monitored this file for many years and has just recently decided to become very proactive, focusing primarily on disclosure, requiring companies to disclose. That's a really powerful thought process that forces the thinking within companies and getting that out to the supervisor, but to others about how these are being managed within the companies. And frankly, their commitment at OSFI to always deal with prudential matters, they're pushing some limits here, some of the way they're approaching this issue. I find that exciting, and I think that's helpful. So how FSRA can move around some of the leadership coming from OSFI, there are many institutions that are not federally supervised, and to expect similar expectations about disclosure, to make sure that they have access to similar type information so that the messaging coming from one regulator in Canada about how the risk is evolving is not contradictory to what would come from FSRA. So coordinating some of the messaging that's going out are just a couple examples of some things that FSRA can do.
Great. Blair?
I very much like FSRA's mandate to serve the interests of consumers. And just a very practical example, and I'm not quite sure where FSRA's authority stops and starts. But for example, here's a simple action item. Anybody who's getting a mortgage in this country with the closing package, and then twice a year as a mail out as a reminder it should follow, they should be receiving direction on how to protect that home from basement flooding, period. If you own a home somewhere where it rains, your house is subject to flood risk, period. And some areas more than others, but that's the way it is. So when somebody gets a mortgage in that closing package, and this is now, the thing that they're going to get up and work for 25 years of their life to pay for, and it's probably going to be their retirement plan, you want to protect that investment. So I would make sure that in that closing package, there is simple, straightforward information, and it exists, that any organization can put their logo on that says, and by the way, for you, the homeowner, and we're now a partner in this deal with you, here's how you protect this property from basement flooding. And the average cost of a flooded basement in Ontario right now is $43,000. So if you have the average flood, that's not the place you want to be. If you can avoid it, avoid it.
That's great. Thank you. So we may have some time for questions from the audience. And we'll see. I think the questions will be popping up on the monitor. Right. So this is a question on how do P&C insurers best educate, inform, and incentivize policyholders to take more action to mitigate exposure to extreme weather.
Okay, sure. I'll go quickly. And up to about maybe 4 or 5 years ago, even when you talk to the presidents and CEOs of the major P&C companies, they said themselves that the direction they gave to policyholders on how to protect properties from flooding or wildfire and so forth, or what even their coverage was very poor and confusing. So one of the things they're doing now is, first of all, just in terms of what you're covered for versus what you're not covered for overland flooding, for sewer backup, for just conventional flood risk in a basement, they're doing a much better job, most of the insurers now, explaining this stuff in plain, simple language that people can read and understand. That's good. But also, the insurers are now very much on the leading edge of the curve in Canada as to supporting better understanding of the actions to be taken to mitigate risk in the country from flooding, wildfire, extreme heat, wind. They're supporting that research and then helping to deploy the inculcation of that research into day-to-day operations to actually get risk out of the system. What we want to do is get all the risk out of the system you can, and then deal with the pricing of what's ever left over.
The small part I'd add is the longer answer is I've written a book. So if you'd like to read my book, I have laid it all out in detail. Climate risk implications for the insurance industry in Canada. And call our institute. We have 120 companies that support our work, and we give to them materials to give out to policyholders. We give to them, we have showcases, displays, videos, all kinds of materials. Any insurer in Ontario who would like to use the members, I think 90% are members of our institute. So we give our materials out, and we're delighted to help them promote it to policyholders.
Great. So we have another question, very similar question. This is not about educating policyholders, but what insurance companies can do to prepare, since physical climate change is just going to increase.
So this is where insurance companies are way ahead of the rest of the financial sector. They have models, they have actuarial data on actual losses that they've experienced. They understand which territories, which regions have the greatest risk. They know the features of a home that we've been providing them, saying this home has higher risk, this home has lower risk. That's hard evidence that's available to all insurance companies. It's part of their practices, it's part of their pricing, it's part of their product design, part of their choices about where insurance is available, not available, whatever. There's just a lot of science available. Insurance companies are using it. I'm always surprised when I talk to people who aren't in the insurance industry why they don't use the same information to decide where to give a mortgage and where to make investments. But insurance companies have a lot of data to do this.
Maybe I could add one.
Sure. Yep.
One of where we spend a lot of time now, I spend a lot more of my time with, it's not, I don't need more climate scientists tell me that the climate is, things are bad. or documenting and by the way, the catastrophic loss insurable claims data in the country, it's not just going up, it's going up curvilinearly. Things are getting worse, faster, but we have known solutions. So where I spend my time now is much more with behavioral economists, behavioral psychologists, to look at how do you motivate the masses to behave in a particular way. We've got the tools, but we're not utilizing the tools. So the trick is one of human psychology to a certain extent. So that's where we're spending more and more of our time.
Thinking about how consumers use the information and then providing it to in a way that is that resonate with them. So I think we probably have time for one more question because we'll have to move on to the next session. So this one came from, what do you think would be the right training for boards regarding climate risk? And with so many regulators and bodies involved, who should the boards be following?
Blair and I spent a lot of time talking to boards in the insurance sector. And so I have lots of experience. I could talk about some of the particular questions that insurance companies give about product design, pricing, use of models, avoiding solvency risk. We've had no property companies go insolvent in decades in this country because they've thought through all these things. And so getting the board members in insurance informed is sort of common. Occasionally, I've been invited to some boards that are not in insurance, and I don't get good questions. I mean, there was a time in insurance. I've been doing this stuff for 30 years. Insurance people didn't know what to ask 20, 30 years ago. But the conversations outside of insurance that I occasionally get invited to are very early and basic questions. Insurance companies would never give insurance to somebody who's been designated by the province of Ontario at extreme or high risk of flooding. You just can't get insurance from an insurance company. But you can get a loan. I mean, there you go. So the process, some of the knowledge that is available for boards, management as well has to get going more on these issues. I'm more familiar with physical risk, that's what I work on, but boards, the management and boards really need to get working on this.
And also, not to go back to the depressing stuff, but I don't think we've mentioned this yet, but we now have 10% of homes in Canada are no longer insurable relative to flood risk. That's 1.5 million people in Canada can't get insurance coverage for their homes for basement flooding. They can still get it for theft and fire, but not for basement flooding. The good thing is, given that reality, you can still get a mortgage without flood insurance. However, we're starting to head into a direction where for wildfire risk in this country is becoming so prominent in certain regions that it's just a matter of time, as has already happened in California with Allstate and State Farm. They're not writing new house insurance for fire risk in California. Well, Canada isn't immune to that either. So what happens, let's go beyond Ontario for the moment. If you're in northern Alberta or parts of British Columbia where you can no longer get fire insurance for your home because without fire insurance you can't get a mortgage. I spent a lot of time with CMHC and brought this question up just a little while ago to the lenders working group of CMHC, which is basically the big banks that hold the mortgages in the country, and said, what is the plan for if fire insurance isn't available? What are the repercussions of that, and how are we going to handle this from a mortgage perspective? And the room just goes dead quiet. There was no plan. So this is the direction we're heading. And as bad as it may seem now, it's just, I'm not trying to be dramatic. Actually, I am trying to be dramatic. We need to prepare for a more formidable future that's coming at us. And we're starting to see these expressions with Desjardins talking about we're now not going to hold mortgages for certain communities going back. That's just the tip of the iceberg. It's going to keep coming. So Canada has been sleepwalking in terms of preparedness for climate change and extreme weather risk. We need to pick up the pace. And here's a question to the audience. Canada now has, I'm going to ask the question and then I'll explain it. How many people here, by way of show of hands, and by show of hands I mean like show of hands, are familiar with Canada's National Adaptation Strategy. Okay, so there's more or less 600 people in this room, and there's about 7 people have heard of Canada's National Adaptation Strategy. Get familiar with it. Canada launched its National Adaptation Strategy of June, July of last year. The primary minister on it is Minister Guilbeault, from Minister of Environment and Climate Change. In that strategy, there are 26 targets in it that Canada is to meet from an adaptation perspective, 10 of which are to be realized or success realized of meeting those targets in 2024, 25, and 26. A multiplicity of them have applicability to financial services. So FSRA, I would say this is an area that it should become part of your DNA almost, and say for those 26 targets, are there 7 of them where we can make a material contribution or something like that?
That's great. We're going to go to our very last question, and then we'll have to wrap up. This is from our CEO. So is there a potential conflict between prudential regulation, which is about solvency and reducing payouts, and conduct regulation that focus on consumer protection, consumer choice?
Yes.
Would you like to elaborate a little bit?
Slightly longer answer is to move away from our climate conversation, talk about earthquake. And on the earthquake file, there are a very large number of people in Canada who don't have earthquake protection. It's available for sale, but they don't buy it because the cost of achieving our prudential expectations are really high, and makes the product being offered for anybody who has it, they're underinsured because they have enormous deductibles and other things brought in. Anyway, so there is absolutely contradictory objectives on some of these issues, and earthquake is the one where if you want to do any homework, you'll find it in your face fairly quickly.
So it's really about working with consumers, educating them, helping them.
You need to do both.
Themselves.
Prudential is really important, and market conduct is incredibly important. So how do you get that balance? That's a challenge.
Something for us to think about. We have to wrap because we have another session coming up. But thank you for sharing your perspective on how the financial services sector can prudently manage the risk, but also keeping consumers in mind. Before we close, 20 seconds each. What are your final thoughts that you want to leave with the audience about specific actions that they can take to manage this risk going forward? Start with you, Blair.
Everybody in this audience, relative to their area of work, should be doing sort of a deep dive self-examination on how physical climate risk may bear relevance to their work. And then the last thought is just the biggest limitation of forward movement in Canada on preparedness for climate change is lack of sense of appreciation for the need to act with urgency. Urgency's got to come higher up on the food chain.
The change that's happened to the climate is very small compared to the change that's going to happen to our climate. And the implications for making good investments by financial institutions, making good loans, providing insurance are going to get much more difficult as the climate changes. And so the supervision for those of us who are consumers, counting on our supervisors, the supervision of financial institutions to make sure they're making good choices about loans and investments and insurance is just going to get more challenging. It'll become more critical for proper supervision over time as things move forward. So think about climate change, get to understand climate change. You don't have to get all the science, you just need to understand how financial institutions are making choices. And are they doing their homework? Do you see them thinking about this well? That's what I'm looking for as the core message back to those in FSRA and those in the regulatory sector.
That's great. Thank you. I know we had a very short time, but thank you for sharing your insights.